How to invest in the second half? Well, let's ask Cameron Dawson, Chief Investment Officer for New Edge Wealth, with me here at Post 9. Welcome back. It's good to see you.
Good to see you.
So what's up with today's action, right? The PCE came in line. No surprises whatsoever. Yields are elevated. And after hitting these new highs for the S&P and the NASDAQ, we kind of rolled a little bit.
Yeah, we are extended and overbought, and maybe that is a little bit of what's going on, which is that the PCE was good. It was right in line. You did see some revisions higher in last month, so maybe that caused people to say, oh, all the data isn't great. But we have to respect the fact that though the trend is higher, in the very short term, you are hitting this wall. We're in the blackout period for share repurchases. You're overbought. You have very extended valuations positioning. It's not surprising to see this little bit of a breather. We'll see if it continues, though.
You know, I don't know if you were one of the voters in our Delivering Alpha quarterly poll here, but we did ask people what's next for stocks. 36% say we're due for a drop of 5% or more by autumn. Now, it's always hard to read into that because you could say, well, we haven't had hardly any volatility, and we're only due for a drop because we really haven't had a drop. Yeah. And when we have, it hasn't been even 5%. So what does this all mean for where we go from here, do you think?
I think that some of this momentum can continue into July. We do know seasonals are typically supportive in July, but then you start getting into August and September, and you start looking around at some of the things that could drive the market higher. One of the things we're talking about is that earnings for 25 are starting to look really aggressive, very elevated, and that's when you start seeing analysts roll forward their models and consider, are we properly calibrated for 2025? We've also seen this deteriorating in some of the economic growth. Atlanta Fed GDP now was just revised down to 2.2%. So how does that square with GDP forecasts, which still remain elevated?
So is this one of the biggest risks then, that earnings are too optimistic at a time when valuations are already what you would say are historically elevated?
Yeah, that's the high bar to jump over, which is that valuations have already priced in great news. Earnings are pricing in great news. Now, the point is that earnings are still moving higher for 2025, and your 12-month forward numbers are still trending higher. That's why this market remains so resilient. The question is, if you start revising those numbers lower because you're revising GDP lower, or you're saying that certain expectations are too aggressive, like margin expansion, which has in at 100 basis points, incredibly aggressive, if those start to be revised lower, that's when we think you could hit more of an air pocket in the market.
I've heard people make the argument that rate cuts, you don't want them, because at this point it's going to mean that something's wrong, that the economy's slowing, that maybe it gets to the point that the Fed has to step in rather than wants to step in at that moment because they're not fully confident that inflation is close enough towards target.
Rate cuts because you can are great. Rate cuts because you should are bad. And one of the things that we're seeing is finally starting to see the impact of higher rates on this economy. Look at the housing data. Look at the capital goods, the durable goods. You're starting to see this weight of higher interest rates on some economic activity. It's not bad enough yet to call and pull the recession alarm. We don't think we're slipping into a recession, but it is enough to suggest that maybe growth forecasts are a little bit too high.
That says to me you probably think it's too soon to expect much broadening out of this market.
I think so. The thing that has been the key driver of the narrowness of the market has been earnings narrowness. The S&P equal weight earnings have continued to be revised lower, whereas the Mag 7 continue to be revised higher. If you look in the back half of the year, though, the bar is highest for the 493 of the S&P 500. The consensus has those estimates going up to the high teens in the third quarter, the fourth quarter, and the first quarter 2025. So that's actually room for further disappointment. So unless there's a good earnings reason for the market to broaden out, we don't think it will.
I guess that's why when we ask the other question, what is the best investment right now, 45% of those asked big cap tech stocks. Go where the money is. People still think that this is going to be the winning trade.
I think that it can be at least until 2025 when we start to see those earnings for the big cap tech start to slow down. The deceleration will be meaningful. The challenge is that we know that big tech is already crowded. We know that big tech is extremely expensive when you look at the overall tech sector. It's above 2021 peaks.
So you think it's extremely expensive? Like extremely?
Well, look, we never want to baseline our expectations to a once-in-a-generation bubble that happened in the 2000s. If we look at growth versus value. Growth is trading at an 80% premium to value. That's back to the 2021 peak, but that's far lower than the 180% premium it got to at the peak in March of 2000. So yes, extreme may not be the right word, but compared to recent history, valuations are very elevated.
I mean, I'm looking at a stock like NVIDIA, for example, which is, before the run was at like 60 times. Now it's 40 times. So how would you assess what that stock has done? Has it left the market a little more vulnerable or not?
I do think that what's interesting about NVIDIA is the last 3 months of its stock move have not been about earnings revisions moving higher. The earnings have gone up. They've gone up by 8%. The stock is up by 80%. So what you've seen is a return to multiple expansion for a lot of these names. You could say the same thing about Microsoft. Its earnings revisions are only up 2.5% this year. A lot of it is multiple expansion. It's not to say that they won't deliver those earnings and that multiple expansion can't continue. It just has to be given a good reason to stop before you actually see it reverse.
It's funny because when you look at other questions in our survey about, outside of NVIDIA, which of those pure play AI related names are going to do the best, and Microsoft tops that list. So there's still a lot of optimism around these stocks, and I think investors are just willing to chase higher multiples because they just still believe that that's where the hype is going to be, and that's where the real results are going to come from relative to everything else.
Yeah, narrative is a beautiful thing, but as long as you still see these earnings revisions, which is a heck of a lot better than you're getting from industrials or energy or healthcare, which have all had huge earnings revisions lower over the last year, which just means that those areas that you were hoping for to broaden out and to give you a bit of diversity in leadership simply can't deliver on the earnings front, so it just gets more narrow.
All right, well, let's continue to debate this with Christina Hooper of Invesco and Malcolm Ethridge of CIC Wealth. Malcolm, a CNBC contributor. Good to have everybody with us. Christina, it's a good segue from Cameron to you because you do think the broadening is going to happen. You do think that we should be buying value stocks and small cap stocks and cyclically sensitive stocks away from mega cap tech.
Absolutely, because what's going to power this is the strength of the consumer. Now, the consumers, lower income consumers, have come under pressure, but that pressure will start to come off as inflation continues to ease. And so what we'll see is real wages improve, and that will be an important catalyst. We'll also start to get rate cuts. I really do believe we'll get 2 rate cuts this year, and that will also be supportive of the consumer. And so if we don't see unemployment go up significantly, this could be an environment where we actually see a reacceleration. So that takes me to the cyclicals, to the small caps, areas that are likely to more fully participate now. It's not going to be as narrow a market.
You want to come back at that?
Yeah, I think that we're growing a little bit more concerned about the consumer and seeing that it is the bottom cohorts of the consumer that are really starting to deteriorate. And we don't necessarily see the catalyst for that big acceleration. I had a conversation with some industrial experts and talking about what they're seeing boots on the ground. They're saying the macro is bad. Earnings estimates are getting cut. You're not seeing this lift to things like PMIs. We get the update for the PMIs next week, which just means that we're still in this muddle through. Economic surprises are still negative, and that's why we're still thinking that those with idiosyncratic earnings growth are likely those that lead.
Malcolm, how do you see this, where Goldman's Tony Pasquarello says, my instinct, and he's been bullish, and he's been correct. My instinct is now would be a good time to tap the brakes. A little bit anyways. It's a bull market, but the probability of a drawdown's rising. So I'd look for the places to reduce overall portfolio risk as we navigate the next phase of this political game. What do you think?
Yeah, I don't see too much flaw in that argument, especially when you look at names like NVIDIA, for example, that have carried the market to this point. I definitely think we're entering a space where maybe we don't hit the pause button, but we definitely see a lot more volatility than we did in the first half of the year. I know we're hanging our hats on the statistic that as we have a strong first half to the year, that means that we're setting up for a strong second half to the year, and 15% so far to the positive really helps to make that case. But I also think in order to get there, the ride is going to be pretty rough. So anybody who's sitting on massive gains in names like Microsoft, NVIDIA, Apple, et cetera, it's not a bad time to be looking at least trimming the position or even putting in some protective puts, maybe if you're not willing to sell. But separate from that, I don't know that the broadening is going to extend as far as small caps and other names that I just heard. I think where the broadening is likely to happen is really in those top S&P constituents, especially in tech. So I think there will be a broadening across mega cap tech as the AI narrative continues to power the markets right now. But I don't know that it's going to extend to other places in the economy.
Christine, I mean, if the consumer and the economy are softening a bit, I mean, I think the evidence would suggest that that is in fact the case. Wouldn't you be a little early for small caps?
So it all depends on what happens to the consumer from here. And we're certainly seeing those lower income consumers under pressure. We've seen credit card delinquencies go up. We've seen credit card balances go up. But that's relative to pretty low levels. We're where we were pre-pandemic. In some cases, we look better than where we were pre-pandemic. So what I would argue is that we're at a crossroads now, and the Fed will be a big determinant of what happens to the U.S. consumer. If they're willing to start cutting soon, and I would make the argument that they can and should, then that could be a different outcome than if we stay at very high rates for a lot longer.
Okay, so this is a binary conversation. That's what this essentially is. It's binary. If the Fed cuts twice, like you say, your trades are likely going to work. Your positioning is probably going to be right. If they don't, that's not going to work.
Absolutely. So let me give you why I think the Fed will cut. Right now, with core PCE at 2.6%, we have a Fed funds rate that is 2.7% higher than that. That's the most restrictive we've been since 2007. If we look at the San Francisco Fed's proxy Fed funds rate, which factors in other monetary policy tools, we're at about 6.3% right now. This is pretty restrictive given the environment and the progress we've made on disinflation. So I think this actually makes the case for a July cut. I don't know if the Fed will be that bold to do that, but I think we will get a September cut, if not a July cut.
Mohamed El-Arian was with us the other day and argued for the very same reasons that you mentioned, too, although he thinks the economy is weaker than most people would otherwise want to believe, that they should cut now. They should cut in July. Now, I think the chances of that are reasonably low, right? Pretty low at this point. Others make the case that rate cuts for any reason are going to be positive for the market. That the chances of us going into a severe or steeper recession, let's say between now and the end of the year, unlikely. But the Fed wants to cut. They keep telling you they want to cut. Bostic yesterday said, yeah, it's probably appropriate to cut later this year, and that's going to be positive. Why get negative in front of that?
Yeah, I think that that's a really fair point, which is that we do know that it can lift animal spirits. Maybe it re-enlivens the IPO market. You heard from Jeffries saying, look, if we just get a little bit of easing in the backdrop of policy, then maybe we could see some better activity. I think the challenge would be is what does one or two cuts actually do to the underlying economic picture? If we really are starting to tip into a softer period, does 50 basis points make that much of a difference? Maybe it does.
Psychologically, doesn't it? I mean, if that, it's not the 50 basis points that make the biggest difference. It's that 50 basis points is eventually going to become 100 basis points, and probably 200 basis points, and maybe 250 basis points. So you're at the start of something, just like before when you were at the start of the hikes. The market saw that and sold off. But
the Fed has never cut rates by more than 75 basis points without a recession in the last 40 years. So if you're thinking that 3 cuts leads to 9 cuts, which is what's priced in through the end of 2026, you're effectively saying, I think that growth is going to slow materially at some point.
Well, we also haven't had inflation like this in those same 40 years. So if you are forced to hike so much and so fast, and then you just want to normalize policy, it's sort of like history kind of goes out the window. It's hard to cite precedent for what they've done towards what they might do next.
The Fed did keep real Fed funds rates between 2.5% and 3% for 3-year periods before the 2000 cuts and before the 2007 cuts. So there is precedent for them to keep real Fed funds rates elevated.
Hey, Malcolm, if we only get one cut this year, let's just assume that we're going to get one, right? It feels like we're going to get one, at least, okay? Is that good enough? Is that good enough to take the S&P to the 6,000 target that Evercore ISI has on it, for example? I think they're the highest on the street right now.
Yeah, I am actually leaning more toward Cameron's camp, I think. I think that 2 or 3 cuts that you're talking about in the next, let's call it 9 months, doesn't necessarily get us to a place where all of a sudden animal spirits come back in the third of the Russell 2000 companies that aren't even profitable suddenly start to power higher and lock in better earnings. I don't know that that actually is the case. I think one cut actually is negative, like you started off talking about, where it makes investors cautious enough to say, well, what is happening underneath the surface that the Fed sees that we don't see? Maybe it is time to get cautious and actually hit the brakes. And unless they're willing to go, the 6 or 7 cuts that are baked into a lot of the analysts' expectations for next year and make it clear that that's how aggressively they're looking to cut, I don't know that it actually helps. And I think wedging somewhere in the middle does more harm than good. It doesn't actually get us to where we want to be. So I'm more concerned at this point that the Fed has boxed itself in to where one cut in 2024, where we came into the year expecting 6 or 7, does more harm than good.
Man, we haven't even talked about alternatives to equities, right? Fixed income. I think there are probably a good amount of people who are still, Christina, sitting in cash, like in the, near 5%, 4 or 5%, or whatever they're getting. What about opportunities outside of stocks?
So I think there's a lot of opportunity in fixed income. I mean, dare I say it's a golden age of fixed income. It looks certainly that way if you compare it to the last couple of decades. So there's a lot of opportunity, and emerging markets bonds present opportunities, corporate bonds, high quality, high yield presents opportunities, munis. I'm really excited about munis right now. So there is a lot of potential there. There are a lot of places for investors to go, including bank loans.
You say corporate bonds, high up on the quality
investment
spectrum?
Grade, yes, but also high quality, high yield. I mean, there are opportunities there. I don't think we're going to go into a recession anytime soon. That is a low probability, in my opinion. I think locking in some level of duration makes sense as well.
Cameron?
Yeah, we do think that there's lots of opportunities within fixed income, munis specifically. Within credit, we think we have to be very selective because what we've seen is spreads come in a ton. If you look at the BBB, BB spread, so the spread between investment grade and high yield, what you're seeing is actually lower today than it was in 2021. So it just means that credit is priced for perfection. It's priced for perfection because people don't see recession risk. If that starts to kick up, just be aware that there's not a lot of wiggle room to surprise to the downside.
So as we make the turn into the second half, Malcolm, look, everybody, is going to be watching the equity, the major averages, obviously, but bond yield's interesting today, right? The fact that yields are up with the PCE, is the direction of yields still going to be the deciding factor for the near term in where stocks go?
Yeah, I think actually, assuming the ladies are right and fixed income is about to finally join the party as far as that side of the portfolio becoming more important than it has been in quite some time, I think that might actually be seen as a negative for the markets as well, considering the yield curve would actually have to normalize at that point. And we haven't had that conversation meaningfully in quite some time about what happens after the yield curve finally normalizes after being inverted for so long. But I think that does at least bring it back into the zeitgeist, which from a narrative perspective can't be constructive for markets, especially in a place where we're already talking about being on a razor's edge because valuations have gotten way stretched beyond our imagination.
You disagree with that?
No, I think that is very reasonable, and we do wonder if one of the reasons why yields are up is because of the results of the debate last night and the question of will Trump's policies potentially be more inflationary.
Oh, interesting.
When you think about the labor market, you think about tariffs, things that could potentially cause inflation to reaccelerate. I don't think anybody is pricing in a 2025 reacceleration in inflation. That would be a big surprise.
Yeah, glad you mentioned that. Cameron, thank you. Christina, thank you as well. Malcolm, we'll see you soon. Good weekend, everybody.